Welcome back. In this session, I will continue to introduce you to how you can measure an accounting item. We previously talked about in the recognition, we actually mentioned about if you want to faithfully representing a phenomenon, if you want to recognize it, it does have a close relationship with whether you can measure it or not. So measurement is a process of determining the monetary values at which the elements of the financial statement are to be recognized and carried in the statement of financial position and statement of profit loss account. The new conceptual framework contains guidance on different measurement bases. The most commonly used is a historical cost, the cost incurred by the entity at the original transaction date. It also uses current value basis. And under this basis, you would have fair value, which is also very much being used and encouraged by the IASB. That is, the price would be received to sell an asset or paid to transfer a liability. So it's very much like the values that you would be receiving, or the values that you would be realized if you decide to sell the assets at this particular moment at this time of your measurement. You would also have a value in use, that is the present value of the cash flow that an entity expects to derive from the continued use of an asset and from its ultimate disposal. So sometimes you need to discount the future cash flow or future economic benefit you're expecting from this asset and discount it to the present day, and you get a value in use. Carrying cost would be the amount to pay to acquire an equivalent asset, which means if you decided to throw this asset away and you want to get a new one or equivalent one, how much would you spend? So you need to select appropriate basis using the relevance and faithful representation as the criteria in order to help you to approach what kind of basis you're going to use for your measurement. To a larger extent, the IFRS measurements are based on estimates, judgments, and models rather than exact depiction. There are problems with elements and recognition. So for example, when you decide how relevant the information is, how high does the probability of future economic benefit needs to be? So if you find an asset that it meets the definition of asset, and the next step you're thinking, how probable that this would bring me some future economic benefit, and how high that you need to set that probability. Does it need to be over 50%? Does it need to be over 80%? Or does it need to be nearly 90% or 100%? And how do we decide what it means to be a reliable measurement of value? Because at the end of the day, that we are using the cost that we have incurred in the past as a result of the transaction, or we are using the values that is for exchange value, for example, in the fair value system. But if, for example, you have something that is not easily for exchange, there's no external market. Let's say you have owned a precious painting. It does not really have a market there. It's been painted by someone really famous and there is no such a market, so there's no way that you can decide what's the value of it. So how would you be able to measure the value of that particular painting? So in this case, you do need professional judgment to select appropriate basis for you to measuring that items. Presentation and disclosure. One of the enhancing characteristics that we have been discussing is you need to make your financial statement and also make your financial information to be understandable and comparable. So that makes the idea of the presentation and disclosure is very important. So they need to follow certain format and the way of their presenting so they can compare across the different company or across different countries. And it also enhancing us to make our information become more relevant and also make more faithful representing the situation, because it enables effective communication. So it's not going to obscuring the users. It's not going to make frustrating the users. Effective communication of information would require that focusing on presentation and disclosure, objective and principles rather than focusing on rules. And classifying information in a manner that groups similar items and separate dissimilar items. Aggregating information in such a way that it is not obscured either by unnecessary detail or by excessive aggregation. So it's quite easy to understand. You want to put information like and alike. So you do not put apple and pear together. You put apples together with apples, or you put fruits together and in separating from meat, for example. When you're aggregating information, you're not putting things that are not aggregable. So you're not trying to calculate things that they should not put together, should not be added together. So you need to put information that is able to communicate on the one hand, but also is not too long for the users to make sense of it. So as I said, the statement of profit and loss and other comprehensive income, it can be divided into two parts, this profit and loss account and a statement of other comprehensive income. And the statement of other comprehensive income, sometimes they would be recycled into the profit and loss account in the future period. So for example, changes in the asset or the changes in the liability. And when the asset or liability has been realized, that say the asset has been sold or the liability has been repaid, then those changes will be realized in the profit and loss account as income or as expenses. There's certain note for the bookkeeping part if some of you have not done it before. So the financial position, which usually would also call it a balance sheet equation. So it contains the resources that minus the claims and equals to the shareholders' equity. That is, the asset equals liability plus shareholders' equity. For financial performance, what usually we're referring to is profit. So profit equals to revenue minus expenses. So when you're trying to do a double entry bookkeeping, you would debit the asset or expenses and then credit liability or equity or income. So for example, you have a cash 10,000. That means you have increased a cash or an asset cash 10,000. Share capital is the equity, so it's the credit 10,000. And now what you're going to do is you're going to pay for 5,000 in order to buy a vehicle. So in your bookkeeping, then you would have a debit 5,000, a vehicle, which is an asset. So your asset increased by 5,000 and your cash decreased by 5,000. So both the vehicle and the cash are assets. So I'm going to make a note here so you can understand. The inventory. So the inventory is part of your asset. So you could have increased your inventory. That means you have bought more stocks from your suppliers. So it's an asset that increased. But because you have purchased more stocks from your suppliers, that means you also need to pay your suppliers for 2,000. So the payable is your liability, and the liability increase. If we move away from the double entry bookkeeping, we trying to translate it into a financial statement, a very simplified one. Then you would have three assets. their vehicle, you purchase a vehicle, you purchase an inventory, and the vehicle is coming from the cash. So your original, you have, let's say you have opening balance. This is your closing balance. I'm super sorry. I don't have the pad at the moment, so that's why I'm dragging my mouse in order to make it work. So please bear with this very terrible writing. So opening balance means the situation at the beginning of the financial period. And you don't have a vehicle at the very beginning, so it's zero. You don't have an inventory at the very beginning, it's zero. You have a cash, which is 10,000. And now become 5,000, right? So the 5,000 goes into the vehicle. So you have an increase in your assets and a decrease in your assets, that balance. And then you have an increase in your inventory, 2,000. But because that inventory is not paid by cash, so it's actually you are owned to your supplier. So you need to pay your supplier in the future. So it gives rise to a liability. So the opening balance of the liability was zero, but now it's become 2,000. And your share capital is 10,000. And that was at the very beginning when you were investing. So that was your beginning balance. That is the 10,000. So at the beginning of the year, you have 10,000 cash, and that you have 10,000 share capital, and that equals, and you don't have any liability. It increased during the term. So you have 2,000 increased in your payable. And so at the closing balance, you have 12,000 in your asset, and then 12,000 having your liability and equity together, right? So that's clear. Right. You will have more such of this very simple examples later in the sessions. So I put up the quizzes and also the practice questions. Do have a look and practice with it, and also upload your answers and attempt the quizzes as well. Thank you.